Hi everybody, in today's video I'll talk about stocks and shares ISA and tax. There seems to be quite a bit of confusion about it and I thought let's clear it up a little bit. Shall we start? In case you're new here, I'm Marta. I'm a Polish turned British designer living in London, and this channel is my personal finance and good life playground. Welcome. I got plenty of questions from you recently. Thank you for all of them and for all the comments. I will tackle the ones that concern stocks and shares ISA and tax today. Here they are. I keep the original writing, so do excuse the typos and so on in some of them. Number one, can I pay into a cash ISA with my bank and a stock and shares ISA with Vanguard in the same tax year? Or will I need to stop paying into my bank's ISA once I have opened a stocks and shares ISA? Number two, so an ISA can have more than 20k, you just can't put more than 20k in a year. Number three, when you reinvest dividends, is that tax efficient? As I understand, you have used up your ISA allowance. Number four, can I transfer my stock and shares ISA? What are the rules there? Do I need to wait for the next tax year? And number five, I'd like to both invest in an index fund and invest in individual stocks on the side. To be tax efficient, I'd need to use a stocks and shares ISA, but apparently can't have one with two companies at once. Vanguard only offers index funds buying, so if I wanted to buy individual stock with trading 212, for example, it won't be as part of a stocks and shares ISA. Is that correct? Is there still a way not to pay taxes on individual stock buying in this scenario? Quite a few questions. I will return to all these questions throughout this video, so don't bother your short-term memory with unnecessary work. Just relax, have something sugary or energetic for your brain, and let's get down to it. All these questions have one thing in common: a slight misunderstanding or lack of clarity about what an ISA actually is. Now, hands up who thought, don't be silly, I know what an ISA is. It's a tax-efficient way of saving money. It's an individual savings account. It's a tax wrapper. Yes, true, all true, but still, let's make it extra obvious. And for that, I'm going to need props. You know, as a designer, I think in visuals, it's much easier to understand it this way. Okay, so talking about ISA, what do we need first? We need money. Luckily, I have a stash here in my house. Do you play it? I do, but I admit that I'm terribly, disgustingly awful. We're going to need some boxes, and we're going to need some scarves. Now then, we agreed that an ISA is a savings account, and a savings account is similar to a safety box, right? So let's grab one. Let's make it a stock and shares ISA, because we're interested in this one most today. There it is. But we can have other types of ISA, 3 more to be exact. We can have a cash ISA, innovative finance ISA, and we can have a lifetime ISA. I used this box for a lifetime ISA because this type of ISA can be used to purchase a property, so the houses make it much easier to remember. Alright, so these are the types of ISA available to us. Now, I'm not going to go into detail about each of them because for the scope of this video, we're mostly interested in this type of ISA and tax. And no matter how useful information is, if it's not useful to us at this very moment, it's irrelevant. Now, let's open these accounts. This one is open already. And grab some money. Look at this stash. Now, I'm guessing, or even betting, that most of you know that the maximum amount of money we are allowed to pay into an ISA per financial year, so the year not starting in January, like a calendar year, but the one starting in April, is £20,000. Am I right? I'm right. So let's grab 20,000. I calculated it earlier. This is 15,000. 1,000, 1,000, 1,000, 1,000 and 1,000. So we have 20,000 pounds here. If only it were that easy in real life, huh? Now, rule number 1, we can open only one of each kind of these in a financial year. So we can mix and match. You can have this one with this one, or this one with this one, or we can have all 4 of them, but we cannot have 2 of those, or 2 of those, or 2 of those. We cannot open 2 ISAs in the same category in the same financial year. Let's repeat it. We cannot open them, but once they were opened in the previous year, let's say you had a cash ISA in 2019, and now you want to open another cash ISA in 2021, you can do so because they different financial years. So in different financial years, you can have different ones. You can have more than one in the same category, but in the same financial year, you cannot open 2 of the same category ISAs. Make sense? Now, rule number 2. The maximum amount we can put into these ISAs per financial year is £20,000. We already agreed on that. Yes? Yes. The maximum we can put into a lifetime ISA is £4,000. So let's do it now. 1, 2, 3, 4. Done. We've got £16,000 left. What do we do with it? Hopefully you want to save it. So we can put £1,000 into our stocks and shares ISA, and we can put 15,000 in our cash ISA, right? So we can split this 20k, or you can put it all into one account. So we can put it all into stocks and shares ISA, and our allowance is done. Or we can put some here, some here, some here, a little bit here, and a little bit more here. It's up to us. Does this make sense? I bet it does. Okay, so let's move on. Rule number 3. We're going to actually focus on stock and shares ISA because this is the one that we want to talk about most. And we'll leave cash ISA here as well, but we'll remove the lifetime ISA and the innovative finance ISA. Now the rules here are, if you have an inflexible ISA, and most of them are inflexible, what happens is if you put money in and then you withdraw it, your allowance is still reduced. What does it mean? Let's take a look. Let's imagine that we opened a cash ISA and we put £10,000 in. 1, 2, 3, 4, 5. And I counted here, it's 5k. So that's £10,000, okay? And then one fine day, we see, well, in my case, I see a beautiful sofa on sale. And it's £3,000. And I decide to use my savings and pay for that sofa. So I withdraw £3,000 from my ISA. Here we are. I'm spending it. Now, how much more am I allowed to pay back into my ISA in the same financial year? A, £7,000, B, £13,000, or C, £10,000? The correct answer is C, £10,000. How does this work? Our allowance was £20,000, right? We put in £10,000. So 20 minus 10 leaves us with £10,000 of allowance. We took out £3,000, but taking that £3,000 out of our cash ISA still reduces our allowance, which means nothing changes. That £10,000 is still the maximum we can put in, not 13,000. So even though logically you would think we created that hole, we took out these £3,000, our allowance is reduced. If you find it too complicated to understand, I suggest that you remember one thing. Your ISA ignores any withdrawal transactions. It just doesn't register them. That way you know that the moment you take money out, your ISA doesn't see it. It's as if you never took it out. And that's how your allowance will be reduced. If you ask me why this was introduced as a rule, I can only guess that this was to encourage people to save more long term. By the way, I think we already answered this question. It depends on how much money you have in your cash ISA, doesn't it? If you have £20,000, of course you're not going to be able to open the next ISA, but if you don't, yes, you can open a stocks and shares ISA in the same financial year. Will you have to stop paying into your cash ISA? Again, it depends on the amount of money you already have in there and the amount of money you're planning to pay in your stocks and shares ISA. Just make sure that in total you pay £20,000 in both. And by now you know that we also answered this question. Yes, you can keep paying into your old ISA in a new financial year. New financial year means new tax allowance. So let's take a look at my Vanguard ISA and the overview screen. See this battery? It will be empty at the beginning of April and it will say how much money I can still put into my ISA. The account will be still very much open and I will be able to continue paying into it using my next year's allowance. So then, now we know what an ISA is, we know the basic rules for ISAs, and now we need to understand its tax efficiency. And for this, we will need our ISA and we will need a scarf. I got this as a gift for looking after somebody's business when they were away on holiday, so it's all connected to money. You probably heard the expression, ISA is a tax wrapper. This is our wrapper. This is our ISA. Let's put some money in it. I always like to put 20k so that we know that we actually used up our tax allowance for this year. And we can close it. That's the ISA. This is what is going to make it tax efficient. Now, I tried to explain it once to a friend of mine and her eyes went Krispy Kreme original glaze within seconds. So I do hope that you're still with me. For this exercise, we want to invest our money. So we put £20,000 into this account and we want to invest it. The moment we put that money inside, we hopefully exchange that money into funds. And we own those funds. So it's not physical money anymore, it's funds we have inside, right? Without a tax wrapper, this is very similar to all generic accounts on major trading platforms. In other words, it's not tax efficient. So let's make it tax efficient and let's put it in a tax wrapper. This is not going to be as elegant as furoshiki, the Japanese art of gift wrapping in fabric, because we don't have time for that. But that will do. Fantastic. Done. Now this is our tax efficient stocks and shares ISA. Use your imagination. Now, what does tax efficient actually mean? It means, in most cases, tax-free. Yes? Yes. But what exactly is tax efficient here? Come on, give me your answers. If you said money, you're right. Yes, the money we put inside is tax efficient. But remember, we change it into funds. So the funds inside are tax efficient. So what happens to this money inside? What happens to those funds? Let's say a month passed, 2 months, 3, 4, 5, you get the picture. What happens inside? Magic happens inside. The money multiplies. Whatever we put in, so the capital, will hopefully change its value, will go up. So the price of the funds will go up. And also the funds will pay us dividends. So what we do here is we count on growth and we count on passive income. And so it's time to look at this question again. So what's our situation here? We put £20,000 into our ISA. Now it's nicely and securely wrapped, it's tax efficient. And then we got some dividends, we got some income. And we decided to reinvest them. Now, will these dividends be taxed? Now let's take a look at our rule number 1. Who remembers it? You can put maximum £20,000 into an ISA within one financial year. That's the rule. Yes, we've done it, we repeated it, it's all super clear. So the question we need to ask here is, where are the dividends? Are they outside or are they inside this box? We don't have anything here, so it's pretty clear they are inside. So the rule of us putting the money inside the box has not been broken. The money is already in the box. And whatever is in this wrapping is tax efficient, which means it's tax-free. So any money this 20K makes us from growth or from passive income is tax-free. So if we want to reinvest it, we never took it out, we never put it back in. It's all within the same box. So that's why the answer to your question is yes, you can reinvest your dividends and it will be still tax efficient, despite the fact that we put £20,000 in. Now let's move on quickly to the next question. The answer is yes. If you opened your ISA in the previous financial year, you can transfer parts of it. But if you opened your ISA in this financial year, you need to transfer all of it. The process is very similar to switching utility providers. So you contact your old utility company, so your old ISA provider, you ask them for the exit fees, because they very often do have them. And then you contact your new utility provider, so your new ISA provider, and you ask them what they need from you. They will tell you usually a list of things, what documents and what numbers and whatever they need. And then you provide them with that, and then they do the rest behind the scenes. Very, very streamlined and similar process. To make it super clear, your old ISA does not affect your current financial year's ISA allowance. So your old ISA will be basically already wrapped up product, and then you just add it and you have a single one here and another one here. So you have two separate ISAs in one financial year, because that one is kind of closed. So you can transfer it to this year without affecting your allowance. Essentially what you're doing here is you're changing where your ISAs are being stored, whether in a different bank or on a different trading platform. Now let's move on to this mammoth of a question. Firstly, let's simplify here. That's true, you cannot buy individual stocks via Vanguard, but you can do it the other way around. You can actually open a trading 212, for example, ISA, and buy Vanguard funds this way. Some trading platforms offer lots of ETFs, lots of index funds. So if you want to simplify, you can do it this way instead. But let's assume you actually do want to keep two accounts. One Vanguard account and one trading 212 account, as you mentioned. So one for your index funds and one for your individual stocks and shares. Let's correct this part of the question first. Apparently, you can't have one with two companies at once. Now, I assume that this is a mental shortcut, but let's get to the bottom of it and correct it anyway. It's not true. I have a stocks and shares ISA with Vanguard, and I also have a stocks and shares ISA with IG, which I opened years back. So the one with IG is an old ISA, and the one with Vanguard is the one for current tax year. So yes, you can have two accounts with two different companies, but you cannot open them within the same financial year if they're in the same category. So we're talking about stock and shares ISA, different years, fine. The same year, to open them in the same year, not fine. Now then, what is the problem here? We have the stock and shares ISA, but we want to open a normal generic trading account, right? Another box. This is our generic account. What is the difference? Tax efficient, no wrapper, so not tax efficient. Maximum 20K, no maximum. Let's put as much money as we want inside. Yes? Yes. By the way, you can have as many of these as you'd like within a financial year. Completely different type of product, completely different rules. Now, is there a way to not pay tax on any money that multiplies inside of this box? This is such a positive video, I'm telling you. I only have yes answers today. And the answer to this one is also yes. You can be tax efficient with some of the profits this account makes you. Great Britain is fantastic with encouraging people to save and to invest. So it offers lots of tax allowances. And it also offers you tax allowance for this account. By now, we know the spiel. The money inside grows and the money inside generates us some income, dividends. Again, we're counting on growth of the capital, of the money we put in, and on passive income. The first £12,000, 12.3K to be exact, on the growth, so on the capital gains, is tax-free. Fantastic, right? Now the thing to remember here is what capital gains are. Any profit is not a profit until it's realized. It's the same with loss, but now we're interested in profit here. So if you have your stocks here and they grow in value, so the price of the stock goes up and you decide to sell, the moment you sell, that is your capital gains. That's something that is taxable. But if you don't sell it, you don't need to worry about tax at that point. It's very useful to know because if you have this allowance per financial tax year, you can actually sell off your stocks and shares gradually. So that way you can be more tax efficient. Now what about dividends? Another piece of good news here. The first 2K on your dividends, so the first 2,000, the money inside makes you in terms of passive income is tax-free within one financial year. Now these are the rules that are correct for this financial year. These rules might change, and if they do, I will have to update the description of this video. So depending on when you watch this video, look out for the update in the description. The last thing to remember, I mean there's more things to remember, but the last useful thing to remember is that the moment you do make some profit from this account, you need to declare it. So you need to complete a self-assessment. You don't need to complete a self-assessment for your ISA. Alright guys, that was a long video. I hope you're still awake. And these were the questions about stocks and shares ISA and tax that you asked. And I hope I answered them in a way that you find it easier to understand. Thank you very much for your questions. They're excellent questions, and I'm pretty sure that many people have them, but don't ask them. So great job for trailblazing the tax inquisition. I hope you enjoyed this video. I hope you found it useful. Thank you very much for watching, and I'll see you soon. Bye-bye.